What's up, guys? I'm nobody special, and I'm very lucky today. I have David Morgan here with me from the Morgan Report. David, how you doing this morning?
Jack, I'm good, thank you.
Thank you for talking to me. I've also got a copy of David's book here, The Silver Manifesto. He was nice enough to sign this for me just now. So we're here at the Silver Symposium, and it's been a great couple of days. People are just rolling in right now. It's a little early yet. I enjoyed your talk yesterday. Give me your high-level view. Where do you see the silver market going over the next, we'll say, 6 to 12 months?
I will, and you know me a little bit, Jack, from the internet. First, I'm going to start with gold. I'm going to talk about silver over the next 6 to 12 months. That's the question. But, you know, on a big picture, one of the best books on the topic of gold and silver is Professor Roy S. Jastrom. And Jastrom wrote a book called The Golden Constant. And in The Golden Constant, he made the reference that we all know that an ounce of gold is an ounce of gold. The mass is the same anywhere in the universe. So that's the constant. And what is its purchasing or value throughout ups and downs in the physical economy? And he went back centuries to determine that gold actually does best in a recession/depression. There's a caveat to that, Jack, and that is that in most cases we were on, or all cases, gold standard sometimes. So gold was the money. So it's pretty logical that if there's less money, less gold in circulation, there's less economic activity or fear. People are not spending, they're saving it. After he accomplished that, he thought about silver, and he said, what does silver do? Which of course is what I wanted to know. And he wrote a book called Silver, the Restless Metal. And in that book, it is not an exact determination what it does. Sometimes silver does good in a depression. Sometimes it doesn't do well. He published in 1953, and from that time backwards, nothing, and I mean nothing at all, held in an inflation like silver does. So now on to your question, 6 to 12 months, are we going to see more inflation, or are we going to see more deflation, or are we basically going to see both? The quick and honest answer is both. We're going to see a decrease in the physical economy. We're continuing to see higher prices for things that we need, fuel and energy, or food and energy, and we're going to see probably a decrease in price in stuff that we have too much of. You know, how many new cell phones do we need? How many more flat screen TVs do we need? You know, how many, more clothing do we need? That kind of thing. But I'm thinking strongly that this is going to be an inflationary blow-off. And coming back a little bit, Jack, Jim Poplava, good friend, had me on Financial Sense News Hour for week after week, and then he started a different format. We're still friends, and I'm still on this program from time to time. But he did a study one summer, read everything he could find on inflations, and he determined every time that there's an inflation that's by an unbacked system, a fiat system, that it went to hyperinflation, or at least high inflation. So the deck is stacked in the favor of money becoming even worth less than it is now, and eventually the perception will be it's becoming worthless. The dollar isn't going to go to absolute zero, I guarantee it. Right. But it may get close enough where people's perception is, I don't know what it's going to be worth, a year from now, but I know 2 months from now it's going to be worth less than it is now. I'm buying more beans, I'm buying more rice, I'm paying off the car, whatever. We wouldn't pay off the car because you'd be paying with cheaper money, but you know what I'm saying. It's the idea that I got to get some protection in this, and for most people that means buying tangible assets.
It's funny you should mention beans and rice, because I get asked a lot, especially by people who don't live in finance and don't study markets very closely. They find out I have a finance YouTube channel. Oh, tell me what stock I should buy, or where should I be putting my money? And I tell them with a straight face, beans and rice.
Yep.
And they laugh, and I say, no, really, beans and rice is probably the best performing asset class across the board right now. If you go back and look, a 20-pound bag of rice costs you about 25-30% more than it does, or more than it did back in January right now. I can't think of many assets that are up 30% this year, not in the first 6 months of this year. So,
that's right.
I kind of chuckled a little bit there when you said beans and rice, because we are in this situation where it's kind of heading more back towards basics. You mentioned prices of things we need are going to go up, prices of things we want are going to go down. We see that in retail. Bed Bath & Beyond stock getting absolutely clobbered this morning right now, but at the same time food prices are rising, oil prices are rising, because we have this bifurcation, if you will, in markets where necessities are getting all the attention, they're getting all the funding, and there's just no money left over in the average budget for all of these nice-to-haves. Now, interestingly, a lot of the nice-to-haves, like cell phones you pointed out, that's a lot of your industrial demand for silver.
That's right.
So that could have an impact on the price in that direction, and yet the inflationary pressures, which I agree with you, I think they are going to come back big time this fall, this winter, especially with what's happening in Europe with their energy markets. That's going to also put upward pressure on prices. So it's an interesting time we live in. What are your thoughts on what's happening in Europe? I know a lot of people put a lot of stock in the energy ratios, gold to oil or oil to silver. Do you follow those at all? Do you believe in that correlation?
Well, I like to look at correlations, but with an engineering background, you can find holes in anything, and most people think linearly, and it's incorrect. You, as an engineer, we got to use least squares linear regression. We got to curve fit this thing, right? And I think Europe has been more socialistic than the U.S. for a long time, and Big Daddy can't take care of you forever. He can until he runs out of money, or the value of the money is entrusted. And that's where Europe's at, that's where we're at, that's where the world is at. So I think they are in a big hurt from the aspect of promising too much, not being able to deliver on those promises, social unrest, and particularly the energy equation going into Germany. I think that's key, that if Russia really does cut them off from that gas in a meaningful way, that will impact it. I mean, I'm try to be non-biased, favorable to any particular thing. I try to stay straight with the facts. I can't, because I'm born a certain color or whatever, but nonetheless, I do my best. Saying that, Germany, in my studied view, is kind of it's the heart of the European Union. It's what really drives the economy, is their productive capacity. Wealth, based on the Austrian school, is what you produce. You produce a lot of stuff, you're producing wealth. Houses, buses, airplanes, iPhones, whatever. So I am thinking Europe is ahead of us, meaning the US of A, by about 6 months. So whatever you see going on in Europe, not one for one, but the general trend is kind of a precursor to what we're going to see.
Yeah, we're already starting to see some of the effect of European energy prices. Natural gas here in the States been on the rise pretty much constantly all summer. It's now up over $9 per million BTUs. Most people in the States are in for a shock with their utility bills this winter because the price of that gas has tripled versus what they paid last winter.
Exactly.
So I see Europe, they are dragging our prices higher. You mentioned Germany and production, right? A lot of the production capacity in Germany is shutting down right now. Their metal smelters, their fertilizer production. So German stuff not getting made, right? That's going to limit the options on the shelves. That's going to reduce supply. So that's also going to put upward pressure on prices here in the States. So I agree with you. I think we're a couple of months behind Europe. I think they're going to export some of their inflation back to us this winter. So it's going to be an interesting time. Now, tell me a little bit about your work. Where can we find you? I know you've got your newsletter, you've got your website, your book, obviously, which I have right here, the Silver Manifesto. Where can we get a copy of this?
My main website is themorganreport.com, and there's a bunch of tabs across the top. There's a tab for books. You just hit the tab, and we sell it directly. Can't get it on Amazon anymore. I took it off for a variety of reasons. We sell it directly on the website, and there's a couple places we won't ship it because the book's like 40 US, but it costs like 50 to ship to some jurisdictions due to their funky laws about trade cross borders and that kind of stuff. So, but overall, and it is in a PDF form. So if someone's out there in New Zealand or maybe the UK where we can't really ship it or it doesn't make sense, we could get you a PDF file. And if you wanted to pay more than the book to ship it, you really wanted a hard copy, let me know. Just go to support@themorganreport.com. I'll make the effort to do it for you.
I'm going to put a link down in the description to that. Fantastic. And David, thank you very much for your time. And any final words? Any words of advice for the audience?
Yeah, Jack, there is. I kind of want to circle back, a famous phrase from PR from the White House. I want to circle back a little bit to silver.
Circle back. Now Jen Psaki, now I get it. She's been off the airwaves for a little while.
For a while. Yeah. So we're talking about silver and inflation and the industrial demand, and you're correct. You know, if we have a contracting economy, the industrial demand for silver could go down. I could argue that yes, going down on the consumer side of industry, but on the military side it's increasing because it's used in weaponry. But regardless of that, the point I want to make is all markets move at the margin, and the margin for silver is and always has been monetary demand. So you could have a curtailment in industrial demand and also a curtailment in smelting capacity and how much other stuff's being dug out of the ground, because 25% of the silver market's based on copper. 35% of the silver market is based on lead and zinc combined. So that's more than 50%. So let's just say, as a thought experiment, we curtail copper, lead, zinc mining because we just don't need as much. That would directly affect the silver market in a big way. But again, to really pound the point, if the perception from not even that much of a percentage of the population says silver's where it's at, we're having more inflation, that will supersede. And we saw that back in 2020. I don't know if you're aware of this statistic. I got it from Steve St. Angelo. Steve does some really good work. And the amount of silver demand in 2020 from the institutional side was 320 million ounces.
Wow.
320 million.
Yeah,
the
we're sitting
retail
now 51 million, 52 million left in the COMEX registered category, so that's impressive.
And the retail side was 200 million. So you combine those two together, you've got 520 million. The total industrial demand in a good year is about half of the supply, which is roughly 1 billion ounces, counting recycling. So that's 500 million. So we had more demand on the monetary side in 2020 than we had on the industrial side. First time ever. I don't know of any time, and I've got data back to Handy and Hardman and some of these old books, and not that you care, but I'm just saying it was a first. Did not carry over in 2021, did not carry over so far this year. It may be resting, and certainly institutional demand will come back at some point. But it took the market from about 18 to 28, and after that move from that 125 to 1 ratio during the COVID, it moved it back from that ratio up to, I forget where it settled at. I think, not that it settled, but I think it went to 80 to 1 or 70. Anyway, it really rocketed up, leveled off, consolidated around 30 and below for quite some time, and now we are where we are. But if you look at the amount of transparent silver holdings, they keep tapering off. So if you looked at that and didn't know what that meant, and I said, wow, you know, people are disinvesting, right? The amount of transparent holdings keeps going down. What that really means is that it's moving out of institutional hands and into retail hands that's buried in the backyard. I mean, that's a bit of a metaphor, but that's what it means. It means that what you can see transparently in the ETPs is not what it was months ago, but yet it doesn't go away and disappear. Some does get used up, of course, but the point is the investment part is going to, I would say, perhaps stronger hands. I think the institutions will be late to the party, just like they were in the gold market. You know how old I am, and when gold really zoomed in the last 3 months from like November 79 through January 1980, it was amazing. It was sort of like the dot-com boom in a more refined way. There were these funds that were coming together to go to numismatic coins, as a play to capture the gold market. Wow. And to me, that's like, oh man, this is it, it's the top. But anyway, so I was a long-winded PS to the interview, but I wanted to get that out, that it's monetary demand. I think it's ahead. I think it's going to be when the rice and beans are there and you have some excess cash. You know the bail-ins are coming, which is the crux of my speech here. Watch out. The bank owns your money, you don't. Where do? You put it in real money and you save it. So,
excellent advice. Well, David, thank you very much for your time. Appreciate it. This is David Morgan. Check out the link down below in the description of David's website. Until next time, live small and dream big.